Okay, now let's talk a little bit about sentiment. Everybody, I'm going to actually come back to this slide. Everybody talks about the AAII, the American Association of Individual Investors. Personally, I'm going to say this right now. I think it's a terrible sentiment indicator because it's mostly probably people over 60 years old, and you know, it's not scientific and it's point and click, and that's about it. And anyway, I have always had a problem with this. I don't know why so many people rely on it. Anyway, that blue arrow, this is released every Thursday morning. That blue arrow represents where the bears are now. You had almost a 15-point jump in bears this week. Okay, so excuse me, the last couple of days or week have really taken people. You can see how the bears in late September, here we go again, over 60%. So again, late September, oversold short term, oversold intermediate term. The McClellan summation index starting to turn. The number of stocks making new lows, fewer and fewer contracting, all right? And bearishness at a pretty decent peak. But notice as the rally goes on, how bearishness falls off. I mean, we've almost halved. We came down to 32, 33 on the bears. This week we jumped up. So people got bearish pretty quickly. I also like to look at the bears on a 4-week moving average. And here, and this I took us back 10 years to show you how bearish people had gotten by early October. This is a 4-week moving average. So, you know, I often say these AAII voters jump around like a bunch of day traders, which I think this one here shows you that when you gain 15 points in a week, that's day trading stuff. But they were very persistent heading into that October low. They've backed off quite a bit now because you can see where it is now. And I've done the math, and even with this week's 47%, it's not much higher than it is now. So they've backed off quite a bit when you look at it, if you will, as a little bit of a trend. Again, I'm not a huge fan. I use AAII as a confirmation. I prefer investors' intelligence. And investors' intelligence is a weekly survey that has been around since the 1960s. And you have to pay for it. And what they do is they survey about 100 newsletter writers. So these newsletter writers have to have people who are paying for their opinion. Okay, so it's not just somebody who's pointing and clicking. And you can see absolutely how they get bullish at the highs and they get bearish at lows. You can see right here, they went from 26% bulls in June up to 45 in August. We came down to 25% in the October low. So far, the highest reading has been 36, 37%. And you can see they haven't backed off that much. Now, I won't get a reading on this again till next week. So my guess is a lot of it will depend on how the market closes out the week. But should we find that as we get to Thanksgiving, again, I'm going to keep referencing that because that, in my mind, is the time that things start to get questionable or could get questionable. If I see the bulls get back up here by then, and I have negative divergences, I'm going to turn bearish. I also look at, this is the NAME exposure index. NAME stands for the National Association of Active Investment Managers. This is free. You can just Google it and you'll find it. It comes out mid-morning on Thursday. It's probably not out yet, but you can see again, here we were in September. Their exposure to the market was 12. Well, Now it's 54. Again, as price goes up, people get more bullish. As price goes down, they get more bearish. I don't know what today's reading would be. They take their survey on Wednesday morning. And since the market was so bad this week on Wednesday, I'm guessing this will notch down. So again, let's just say that the market is okay between now and the end of the month. And this makes its way back up to here. I'm not going to like that. Again, it's going to be too many bulls. Especially, again, if I have negative divergences when I get overbought. Now,
Helene, I have a quick question, and that goes back to the conversation we had yesterday. I love that statement. You said we don't want people to turn bullish so quickly because there are too many people in the bear market, and you had a nice explanation, an example of that. Would you mind just expanding on that a bit? I think that'd be useful.
Okay. First of all, you don't want too many people to get bullish because you like a market to climb a wall of worry. I think too many people think of sentiment. I don't know. I feel like you need to think about it as a tug of war. Picture two houses next door to each other with a fence in between. The bulls live on one side, the bears live on the other side. Okay, and they go out in their backyards. They have parties, and at the end of September, early October, the bears were partying like there was no tomorrow. I mean, let me just go back. Well, I can just go back here. The bears were drinking margaritas, eating chips. They were fat and happy. And the bulls were probably hovering inside, afraid to even show their faces. But what happens as markets rally is the bulls come out. Oh, maybe I'll have a cocktail. Oh, where are the chips? And the bears start looking over. What's going on over there? And they start moseying over to the fence. They don't generally jump from the lounge chair to the bull backyard. That's just not how it works. They mosey over to the fence. They start chatting with the neighbors. Oh, maybe I should just sit on the fence for a little while. And then eventually they crawl over and they go join the bulls. And that's when the bulls get fat and happy. As you can see, the bulls were fat and happy here in early 2021 because there were no bears. So you should always think of bulls and bears almost like an oscillator. People jump back and forth, but they rarely jump directly from the bull camp to the bear camp or the bear camp to the bull camp. Notice how bearish they were here. It comes down in layers, right? And then you get the big jump. This is unusual, but again, that's why I call them day traders. Go back here. Gradual acceptance of the rally, right? Gradual, oh God, the rally is terrible. And that's just how it works. And so if you just think about it as two neighbors talking over a fence, getting closer and closer and further apart, it's easier to understand sentiment. And you never want too many people on one side of the fence, because when there are too many on one side of the fence, you want to take the other side, because who's left to jump the fence? So now we can talk about the equity put call ratio. Just a few days ago, the equity put call ratio jumped over 1. You can see that. Oh, I'm sorry. This is the equity put call ratio scooting up in late September, over 1. I don't know why this doesn't show the recent one. It shows yesterday's at 0.96, but two days ago it was 130. And I don't know why this isn't showing it, because I keep it off the CBOE website. But you can see, first of all, let's talk about late September. People were more bearish in terms of buying equity, more puts than calls, than they were in March of 2020. And the last couple of days has seen this shoot up again. So again, what happens is you've gotten people far too bearish far too quickly. Notice how this jumped up. Notice how, as I call them, the day traders got so bearish so quickly. And the entire time, we're not yet fully overbought, right? This is still rising. I also look at the equity put call ratio on a 10-day moving average because it smooths out all that noise. It's currently 0.82, which you can see is high because you can see where it was, again, late September, early October. But you can see it's almost closing in on where we were in March of 2020. People got pretty bearish in the last 2 weeks. Again, they got bearish while the summation index is still rising. And they got bearish before we were fully overbought.